Hey everybody, welcome to another free edition of our Trader User Group Weekly Roundup for the trading week ending November 15th, 2019. Everybody, I'm Preston Brent. Thanks for tuning in. This week's theme is Follow the Yellow Brick Road. I mean, stop me if you guys have heard this before. But this past week, indexes have made new all-time highs, and all of this against the backdrop of a lot of geopolitical tensions out there and a lot of domestic political infighting going on here with these Trump impeachment trials. So it's just a lot of tension, yet we're making all new time highs. I mean, this past week we saw the Dow cross the 28,000 threshold, also new all-time highs in NASDAQ and the S&P. Okay, the only one that's really trailing is the Russell. I'll show you the chart here in a minute. Last time it made its all-time high was over a year ago, I think September 3rd of 2018. Now, I've told our members many times over the past couple of months that there were three legs to our bar stool for the markets to go back up over 3,000 and run up to 3,100, 3,150. And this was back when we were down in the low 2,900 price zone. Okay, so that was many percentage points lower. I basically said we needed to have really good, not really good, but we just needed to beat Q3 earnings. And even though the bar is very low, that's what we're doing is we're rounding out Q3 earnings this week and the next. We've beat. Okay, it's a 76% beat rate, which is better than the 5-year average. We've got a supportive Fed. We needed that for bar stool leg number 2, and we do have a very supportive Fed. The final leg that'll get us up to the 3150, maybe even 3200, is we need a phase 1 U.S.-China trade deal inked. All right, you get all three of these, we get all three of these, and then the market's going to want to stay bullish. But again, markets are already projecting some of that happening, as the markets always do. And that's what's given us a boost here. So I've been talking about this for several months, and that's going to kind of, I have our members leaning bullish, and we've seen a rotation into cyclicals as well. So that would be like the financials, industrials, maybe semiconductors, and a few others. And I could see this continue here for the near term as long as the market dynamics don't change very much. Also, keep in mind, we've got low interest rates, we've got subdued inflation. U.S. Fed's already on record as stating they would need to see an extraordinary circumstance in order to raise rates. So let's just say we've got a very supportive dovish Fed. So it's like a Goldilocks market environment right now. And also, don't forget the Fed's over the past 60 days or so has pumped another 128 billion into the U.S. economy, or into increased our balance sheet. They don't call it QE, I do, but no matter what you call it, they've printed another 128 billion and pumped it into the economy. Okay, so the markets, with all of this, they've priced in a very accommodative Fed. I think there's only like a 50% chance of another rate cut in 2020. It used to be almost 80 or 90% chance on just one rate cut. Right now, it's only a 50-50 bet. Okay, so a Goldilocks scenario, and against all of this backdrop, as the markets continue to make new all-time highs, we're also seeing this global slowdown starting to shift more towards a bottoming and a stabilization kind of thing, which pushes out the recession fears just a little bit further in time. Okay, so all of that's going to be supportive of price action. And keep in mind, with all these tensions floating around on the planet, Hong Kong protests, China trade deal, bad policy decision by Trump, a lot of these things, all of this tension has kept a lot of money on the sidelines. And this money on the sidelines is going to be pushed back into the market as we move higher, which would further exacerbate this move. All right, I'll show you the difference between this move now and the move we had in January of 2018. January 2018 was completely different. That was a classic FOMO move. Right now, we're not in FOMO. We're moving up, the fear of missing out, but it's nowhere near the aggressive nature that we had. I'll show you on the chart here in just one second. On this chart that you're looking at here, it's a weekly chart of the Ichimoku, right? And you can see here this big supportive green area, and it's also moving up, and it's gotten a lot wider from when we were down here, when price action was here. So basically, this just says that we've got a very strong, solid financial support base underneath us. These Fibonacci extensions that you've seen on here, I've had them on here for a month or two. We came up and hit the prior one a week ago at 3,100. Now we're moving up to the 3,140, 3,150 area. And these extensions were drawn off of a key area right here, all right, right off of that pivot area right there. You can see where we started the year fairly low from this huge, more than 10% move. And literally in the month of December was this move right here. 10% in less than 21 days, trading days. It was amazing. Or 21 calendar days, 3 weeks. It's amazing. So we've got fairly good support underneath us. Okay. So that's a little bit about what I'm seeing here, looking at this Ichimoku. And of course, if we break it down to a daily right here, you can see here as we held up at that first fib node at the 1.236, and now we're moving up to the 138, right around 31.44. That's our next stop. But you can also see the green cloud, which is supportive of us, and it's bullish rather than red. So that suggests if we do pull back, which I would expect a little bit of a pullback, just to kind of ease the markets a little bit, we don't have any divergences. There is no bearish divergence. So that just basically means that any pullback, any little dip in the action is probably going to be bought rather than not. We'll have more cash come in as a buying point. So that's a little bit about what I see on the Ichimoku chart. And then if I switch it over and I take a look at the same chart, the same symbol, only the futures, the S&P futures, but let's look at it from a Bollinger Band perspective. And if we look at it from a Bollinger Band perspective, you can see here as we move up, okay, as we move up on this Bollinger Band, we tend to move up between the 1 and the 2 standard deviation, which in this case is the blue and the purple. I add an extra standard, I've added a 3 standard dev and a 1 standard dev to the traditional Bollinger Band so that you can get a general idea where markets tend to play. On up moves, it tends to run between the blue and the purple, which is a 1 and a 2 standard deviation. That's a normal, good, solid up move. When it touches the red, then it starts to get fairly bearish and the markets start to roll over, right? So all of these moves where the markets get in that momentum move, every single one of them tend to move up between the blue and the purple. The minute we get note that from a Bollinger Band perspective, we break the purple to the downside, I mean the blue to the downside, the yellow is the first stop. And then if we start to move down, we're going to come down and test. But right now, this is the direction of movement, and this is where we want to lean, right? Regardless of what your instincts may say, the markets want to run higher. Now, puts are very cheap right now. I'll talk about volatility in a minute. But for now, look, I want to compare a couple of things with you. If we look at the Bollinger Band here and look at the movement between the blue and the purple, all right, let's zoom in a little bit so you can see, right? And you can see, look at the RSI right here. We're over the, we're in an overbought situation. The last time we were overbought, I have to go all the way back to right here. We were slightly overbought. We pulled back a little bit, but it was a dip to the yellow, as you could see, and then boom, we moved right back up. And then as soon as we broke the yellow, which is the center of the Bollinger Band, we started to give it up. And this was the deadly fourth quarter of last year. But now let's really take it back. Look at this run right here, guys. This is where this is a classic case of FOMO. All right. I mean, really a big classic case of FOMO. You can see this overindulgence right here. I mean, look at how high this is a daily. We're not even up anywhere near there right now. But you can see this run actually started in September, roughly, and then we ran up. It was like a straight rocket ship like that. And look at the width of the Bollinger Band. Look at how wide it was. In fact, on the run up, it's fairly wide, right? We're nowhere near that right now. We would need to see a last dash, and the run up that we saw here back leading up to January, it really didn't kick off until right around here, right? If I draw that line right here and come all the way down, you can see the date right around 2018, okay? That date is 2018, and then all of a sudden it just rocketed higher. I mean, it just, but even then it stayed between the blue and the purple line. But you can see if you discount the move down, you can see the width of the Bollinger Band was very wide. Okay, and that gave us this huge, massive overbought situation. And when you see this kind of move, you definitely want to be picking up puts. Now, we stayed in this for the entire month. And the longer we stayed in it, the more it forced cash off the sidelines into the market because people just think this can just keep going up and going up and going up. And as you guys know, the backside is usually 4x more violent than the upside, right? As far as in this case, you know, it takes one day to take away profits earned in 4 days over here on the upside movement, traditionally, right? But this was a very huge, huge move. So now you can see here that it doesn't look like this right now. We would still have some more that we would need to go to really create that FOMO environment. But either way, a little bit of a dip to me would be in order. Volatility is cheap, as I said, and as long as vol is cheap, then this is kind of how you want to how you really want to be looking at it. So if I want to come over and show you vol, I'm going to switch over my screens again, and let me come over here and pick volatility here. So let's see what screen that is. I think that's screen, no, that's screen, where are we, right here? Here we go, screen 5. Let's go to screen 5. All right, so here's vol. This is a daily chart, and you can see we're in the green down here, okay, which means vol is low. Certain option strategies work better down here than they do in the yellow than they do in here. We got to shift our stance. But more important than just looking at the VIX, the VIX is at close this week at 1205. We could even see 11 handle if the momentum continues on Monday, which is, you can expect a little bit of a momentum continuance and then a little bit of a softening in the middle of the week, and then we'll see where the week wants to go as we go in towards the end. But if we look at the back month skew of volatility futures, look how deep we are in the red right here. This measures the difference between the front and the back month vol futures. And we're already at a difference of 2.13 handles in VIX volatility. Folks, that just shows that there is a lot of shorting, selling of volatility futures going on right now. In fact, the COT, the Commitment of Traders report, you can look at that and it shows right now we got the highest amount of shorts holding vol futures. And what does that mean? That means when vol pops, these folks are going to be covering their shorts, which means a short squeeze, but in this case, it's going to be to the upside in volatility, which you reverse it around, it means the downside in the market. So there could be some ugliness. If we get anything that can light the fire that this kindling is on, right? So we got to be very careful. Take advantage of low vol by picking up some hedges for this coming week. We're still bullish. Don't discard that, but we're subject to these a little bit of a pullback here, which I think is more likely than not. Over the next couple of weeks as we go into the holiday season here in the United States. Keep in mind, we got a big holiday in the U.S., not this week, but next week, where Thursday's the markets are closed. Friday's a half a day, which means traders, not this week, but next week, starting on Wednesday, will be taking a half a day, and then they'll be gone for the rest of the weekend, right? And that kicks off the fun time for the U.S. markets, where traditionally they finish higher 70% of the time. All right, so we're in a very strong seasonal time for the U.S. markets. All right, and this is also, by the way, a very strong seasonal time for small cap as well. So this is a little bit about what I'm looking at. If we look at the bond market, you can see we're in the regression channel to the downside. So this just says interest rates are moving a little bit higher. If we look at the 10-year, you can see the 10-year is moving up. So this is a vote of confidence by the bond market. At least there's not going to be a recession near term. Accommodative Fed, so it just means interest rates are a little bit higher, okay? And then, of course, if we look at the U.S. dollar, it's kind of right in the center line of this regression channel, still up. And as you guys remember, when we get up to the upper boundary of the regression channel, I'm more willing to short the dollar and go long the euro. Down at the bottom, it's just the opposite. And of course, if we look at the euro, it's the exact same thing, but just the opposite, because the euro accounts for about roughly 58% of the dollar index. So we're down towards the lows. So I wouldn't be willing to to chase this lower. I'd expect this to move up. So but that's the probability of move. We got to see where we want to go, but that would be the probability, the higher probability to move. And let's look at the yen. The yen has been moving lower. Remember, the yen is like a global risk off trade, like US bonds. They kind of go together. And the yen has been going down really since the end of August, after the markets bottomed and started moving higher. The yen has been going down. So that's a vote of confidence for the global markets, at least a vote that the global recessionary fears they're finding a bottom, okay, or a trough. So that's what's kind of set the markets here in the US also in action. All right. And if we come down and look at gold, obviously with the markets moving higher, gold, there's not going to be people willing to hold gold because it pays no dividends, no interest. You're holding a brick, a valuable brick, but either way. So you can see this is just more of a profit taking mode here. As long as we're in this channel, I'm not going to be bullish. In fact, we were bullish, not gold, but we were bullish silver, but we had a good signal here to go long gold, as I pointed out to our members. This is back here in the summer months, around June time frame, around 1374, really, the actual number. And then we moved up in this area here. We played it in silver rather than gold because silver was underperforming on a relative basis to gold, so silver was the better play. And that's what we did. And speaking of silver, it is also, like gold, having this little pullback here. It's attempted to break out, but it could not hold. So silver is like a bunking bronco. It wants to run higher, but right now there's no reason to be long silver. So that's a little bit about what we're sitting with in these markets. Okay. And then of course with oil, it's kind of a vote for globability or the global markets. We've been in this range for quite some time. And if you really want to think about it, oil, and I've been saying almost all year, oil has been, it ranges from the high 50s to the low 50s. So call it 55 is the central area. When we run up here, the odds are going to push it back down. And when it's down here, the odds push it back up. Right now, it's running up. OPEC came out and said they're looking at cutting production even more because there's more supply than demand. So OPEC is meeting December 5th through 7th in Vienna, so we'll get word on that. But even if they cut production, it's hard holding everybody in line. And I just don't see too much more upside from here. But as long as we get the global growth story working, yeah, we can run back up to the 60 level. But I don't see us running like we did up in this area here, 62, 63. I don't see it unless we have another wartime event or some strike over in the Middle East, on a ship or some refinery that can set things in motion to do that. And then, of course, if we come back here, if we look at this chart, this is very similar, right? This is the Russell futures right here. And if I put it on a weekly, it looks like just like oil. We've been in this range. The last time we made an all-time high in the Russell futures was September 3rd, 2018, as I said. Now we've been in this range. So what I'm going to watch, one of the things you also ought to do is just kind of look at this level right here. All right, if we break to the upside, that's going to be bullish, very bullish overall markets. There's certain trades you want to be in if we break that high there. It's going to be a great run. And there's other trades you want to be in if we break that low, right? So members, we'll look at it this weekend in our weekly market watch this Sunday evening. If you're not a member and you're just watching the video here, then mark these areas because whichever break, it's gonna run. And there's certain things you want to be in and certain things you don't want to be in if one of these two breaks. Up in this area here, we've been in this range really all year long. This was the move in December, all right? And then we hit January right there. So we've kind of settled on this range right here all year long for small cap. I want to see it break out. That would give the overall markets another bullish reason to run up to the 3,200 area. But let's see how everything flows. If you're not a member of our group, I highly encourage you to come in and check us out. If you are a member, I'll see you guys. Love all of you. I'll see you this Sunday evening at our weekly market watch at 8 p.m. Eastern Standard Time. Otherwise, make it a great weekend, everybody. Enjoy football, friends, family, fun times, and I will see you members tomorrow evening at 8 p.m. Eastern Standard. Ciao, everybody.